Hello, everyone. My name is Tom Parker, Executive Vice President, Publisher for Institutional Real Estate. Welcome to IREI Live's Real Estate Webinar. Thank you for joining us for today's program entitled The Future of Office Investing. First, we'd like to thank our sponsors, Juniper Square and MetLife Investment Management, for underwriting this event. Our program is designed for the investor community with the expectations to provide practical and actionable insights. This webinar will bring together established thought leaders in the real estate office space to help you put opportunities and risks into perspective. During our live interactive panel discussions, our goal will be to deliver insights on the current state of the U.S. office sector and what the future might look like in the space. Please note that approximately 25 minutes after the hour, you'll have the opportunity to send questions or comments by using the chat feature at the bottom of your screen to further this discussion. Excuse me. Also, a recording of this webinar will be sent out to everyone that has registered. It will also be posted on our website and posted on LinkedIn. Hopefully, if all goes right, we'll have that for you by the end of the week. To lead our discussions today, please allow me to introduce our moderator, Nick Russell, Head of Investor Account Management at Juniper Square. Nick, welcome, and thank you for taking the lead today.
Thank you, Tom, and thank you, IREI, for hosting this timely discussion regarding the future of office investing. Every morning, our inboxes are flooded with news about the office market, and today was no exception. On one end of the spectrum, Los Angeles recently experienced its priciest office sale of the year. And on the other end of the spectrum, other primary cities like Manhattan, San Francisco, and Chicago continue to struggle attracting workers back into their offices. Before I introduce today's panelists, I'd just like to remind you about the news that Tom just shared with you. First, this is intended to be an interactive discussion, so I encourage you to please submit questions via the chat feature, and we'll do our best to address them during the session. Then we'll begin incorporating these questions halfway through the session, and we'll conclude by asking each panelist to share their main takeaway from today's discussion. Now that's enough for me. Let's meet today's panelists. Sam, can you please introduce yourself first, and then you, Will, and finally, Jennifer.
Great. Well, thank you so much for having me to IREI. And Nick, I am Sam Spencer. I'm an investment officer at the Oregon State Treasury, the real estate team, and we have a roughly 12 billion in NAV real estate portfolio, and our team functions all as generalists. So I spend a portion of my time thinking about the office sector.
So my name is Will Pattison. I lead the research and strategy team at MetLife Investment Management, covering all of our commercial real estate investments. So my role is to identify the property types we want to invest in, the cities we want to invest in, and where on the risk spectrum we want to be investing.
Good afternoon. My name is Jennifer Stevens, and I'm a co-founder of Alliance Global Advisors. Alliance is an advisory firm that focuses on advising folks in the investment management world, predominantly in the real assets categories. We launched our business in April of 2020, and to date, we have advised investment managers with approximately 400 billion in cumulative assets under management, most of which are in the real estate sector. So thank you for having me here today, and I'm looking forward to contributing to the conversation.
Thank you all, much appreciated. Jennifer, let's keep it with you. How are office returns compared to other property types? And what are you hearing in terms of rumors of any potential write-downs in the office sector, given recent volatility in global macro and economic trends?
Sure, thank you. So right now, we have visibility on published returns through the first quarter of 2022. And which was before the announcement by the Fed. And so second quarter wraps in about 2 days. And I think our entire team is anxiously awaiting the publication of second quarter 22 total returns. But a few managers that we've been tracking outside of our client base are expecting some write-downs in their office exposures in the second half of 2022, but that really depends on a number of factors. The magnitude will depend on a number of factors if and when that write-down occurs. So kind of taking us back to second quarter, or first quarter of 2022, that quarter resulted in really the second highest quarterly return since inception of the US markets if we're looking at NCREIF, MPI, and Odyssey returns. The levered core gross returns of the total Odyssey produced a 7.4% total return, and unlevered core returns were around 5.3%. So this, resulted in the highest ever annualized return. And the important thing to remember is that leverage in the Odyssey also accounted for around 6.5% of the total return when you look at the attribution analysis for the first quarter of 2022. So the sector weightings within these benchmarks in the US are also changing massively, and we'll touch on that a bit later. But with that, there is a large divergence in the property type returns within the index. So the 1-year apartment return, for example, was 24%. The 1-year industrial return was 54%. And those two sectors contributed the largest amounts of the total return. And over that same time period, office produced a 5.8% total return. So it contributed to less than 2% of the total benchmark return during the quarter, and even consistently over the 1-year period. And so when we look at the composition of the total office return, what's also interesting is that the recent quarters have shown both slightly positive appreciation and positive income. But there were 3 quarters or so in 2021 where there was negative appreciation. In addition, net operating income growth, it's bounced back in every single property type with the exception of office, where it continues to falter. And certain managers are forecasting 0 average rent growth over the next 3 years in the sector. So finally, I think on the note about future performance, we're also seeing some signs of pricing declines in the office transaction markets, really as the result of the rising borrowing rates and some of the other performance trends that we'll talk about today. But that's what we know right now, and we're waiting for the second quarter returns to be published here shortly.
Thank you, Jennifer, especially for that context against other property types. Within office, it seems as though Class B and Class C office space have struggled more so than Class A space during the pandemic. Is that typical during recessions? And how long do you expect that trend to continue?
That's an important point, Nick. And the short answer is no. This is not typical during recessions. If we look at the 2008 and 2001 downturns, we did not see this kind of widening of Class A performing better and Class B and C performing worse. And in fact, if anything, the opposite was true, where there was a little bit of a flight to value or flight to lower cost options during and immediately following the recession. That's been very different this time around. And just to put some numbers to it, we've estimated that before the pandemic, so in 2019, there was about a 45% rent premium between Class A and Class B office space. And we think that's heading towards 60%, 60, in coming years. And we're already sort of along the way so far. And that may not sound like a lot, but that really is a huge difference in terms of unlevered and levered returns for those assets. We could certainly, we could spend a whole webinar talking about why that's the case, but kind of the short story there is this war for talent that's been occurring, that's been making employers want to get the highest quality space. And for demographic reasons, we think that's probably going to continue throughout the 2020s, where we're going to have this type of low unemployment rate environment and a continued willingness to pay up for high quality space by employers to attract the best employees.
Thanks, Will, so much for that flight to the suburbs that we've been hearing about. Sam, shifting towards you, before the pandemic, the amenity war had shifted from multifamily to the office sector. Has the amenity war only intensified for office buildings now as companies try to convince their employees to return to the office?
Yeah, thanks, Nick. Absolutely. I think to Will's point, right, this is a battle for the best talent, especially when you're talking about Class A properties, right? Those spaces that we've probably all toured, where you walk in and it's like this high entertainment value, feels like you're in an arcade, and the energy there, that's very different than maybe in a nondescript suburban office park. And those amenities, they're important because they help employees engage in the social element of the work environment and the culture building part of work to a certain degree. I think the issue for us, though, is that they're not free. And capital budgets have been kind of the big predominant reason that our team hasn't loved office investing for a while. So, to the extent that the tenant is kind of building out some of those amenities, it's great. But, if you're not able to kind of push some of that expense to your tenants, it's definitely a large challenge that we constantly are thinking about. And as the kind of amenity war, as you called it, I think continues to intensify as talent remains so hard to find, and the labor market stays tight. That's, I think, going to continue to be a pretty meaningful element in the spaces that tenants are leasing.
And Jennifer, sticking on the topic of tenants, how are tenant preferences changing post-COVID? How are you analyzing all the contradictory news that you see today relating to tenant company preference? So my joke about the flight to the suburbs, yet Will's research about what he's seeing in CBD markets.
Sure. So first, our business is a bit unique, Alliance Global Advisors, in that we were established in 2020, and we were in really March and April of 2020. And it was our intent at that time to form a remote business. And that model, ironically, is one that the whole world ended up flocking to during the pandemic, which nobody could have predicted. And while we do have physical office space, we have office space in Florida, for example, we believe that our entire team actually benefits from the continued flexibility of remote work. And we don't expect to change our format anytime soon. If our team wants to go into the office, they're more than welcome to do so, but we also offer that flexible work environment. So I mentioned that because it helps to set the stage, because we're also in a unique situation as real estate investors and folks that kind of track and cover this market, where it is in our own best interest to see employees and employers back in the office, right? That is the livelihood of our business, and it takes occupancy to thrive. So I don't think we're alone in that our team continues to work remotely. I've been reading a couple of surveys lately where there are employers that are using incentives. About 88% of employers are now using incentives to get their workers back to the office. So of these, 77% are offering a hybrid work environment, and 61% of the businesses surveyed are making changes to kind of the physical floor print, as Sam and Will mentioned. With that, office absorption, it turned negative in March 2020. It really reached a trough, at least to date, reached a trough in June of 2021. And today, there's rumored to be about 110 million square feet of vacancy in March 2022. So at the same time, since the first quarter of 2020, there have been a lot of jobs created, 820,000 jobs created that require the use of office space potentially. In normal circumstances, this job creation would result in 100 to 125 million square feet of additional office occupancy. So I don't think this is a new conversation. Pre-pandemic, there was a trend to less office space per worker. Post-pandemic, there's a preference for more office space per worker. We're hearing that there are preferences for like wide and flat offices as opposed to kind of stacked floors in a narrow floor print. And we're also tracking the office utilization rates by geography and market type. So the number of signed leases is down overall, but the average square foot is actually up per lease. And so, who's leasing the space? We're seeing more technology companies, banking, law, and healthcare tenants enter the markets. Markets like Texas and DC and Los Angeles and certain parts of the Bay Area are seeing growth in return to office. And so, I think that the tenant preferences will evolve beyond where they stood pre-pandemic. And we're starting to see more and more people going back to the office, at least part-time. One of my friends works for a company that has the WTF schedule, Wednesday, Thursday, Friday, which I find kind of amusing. But office has been one of the harder hit segments in the real estate sector, and it just really resulted in a change of the way we do business in the office. And I totally agree with Will and Sam that there is a bifurcation also occurring in vintage and in modernization of office space. The older vintages, kind of the Class B and C offices, are witnessing decreasing demand. Class A offices show increasing demand. One stat that I found really interesting was that buildings built before 2011 have over twice the vacancy. Their vacancy totals around 20% of the buildings constructed between 2011 and 2019, which showed vacancy levels around 8%. So the net absorption levels also support these things that Sam and Will were talking about, with negative net absorption for all vintages of build prior to 2015. So, those are some of the trends that I think are going to continue to impact the office segment going forward. And I look forward to hearing, what the other panelists have to say about that as well.
One thing you said that was really interesting there was how both you and your co-founder really embraced this flexible hybrid style. I think for a lot of groups, you really look to your leadership. And when you see your leadership actually exhibiting those types of activities, I think it really increases the likelihood that the rest of the firm will follow suit. So I certainly commend you for that. We see similar kind of styles within our leadership. And I think it really just drives overall alignment within the firm. So definitely applaud you for that. Sam, how are office use preferences changing by tenant industry? So kind of a follow-up to Jennifer's comments, and how might a shifting labor force market impact this? Will certain tenant types become more favorable due to their space needs and utilization preferences versus others?
Yeah, I think following on, what Jen said, there definitely are so many more ways that flexibility is being kind of built into people's schedules, and even just in like the way people are going out and recruiting talent. I've had a lot of people in my life changing jobs who work in tech, right? And it's a huge differentiator now, kind of the way that they position themselves versus their peers. And I think there is a big split between how office use preferences will change based on the industry. And I think a year ago now, so kind of middle of the pandemic lockdowns, we heard from a head of real estate at a large tech firm in the Bay Area that they essentially were offering all of their software engineers pretty much anything they wanted. And if the engineer said, I want my own desk, I don't want anyone else to touch it all week, and I'm only coming in for a couple hours, 1 day per week, they said, absolutely, it'll be there for you, right? And that type of space use is I think pretty unique to the tech market currently. And that has been a really, really strong labor market up until maybe very recently. We've started to see, some layoffs, some companies just pulling job listings and choosing to not fill them. I think it's pretty early. I'd say those are maybe just early signs of a shift in the labor market. But I do think that, employees feel relatively safe. And so they're currently asking for as much flexibility as they want. And if the labor market does shift further than just, a few layoffs here and there, that could shift the office use preferences, people saying, I will go in 1 more day for that little bit of extra face time or what have you. And on the flip side, that's tech, but we've seen with several of our partners, full accounting teams go remote. And I would just, thinking back to, tenants that we would be really excited to sign a lease with, you know, a large accounting firm, pretty stable tenant. We'd be really excited about them in the past. And now, just given that change in work dynamics, we're seeing so many teams go fully remote. It's like, you know, maybe that's not the tenant that you actually want in your building anymore. So just the way that different industries are starting to use space, kind of bifurcating which employees actually want to come in and don't. I think that's now kind of part of the equation of the way that we think about leasing, which is, you know, kind of new and definitely part of the shifting environment.
Yeah, working with several engineers myself, I can definitely confirm that, where that, again, need for flexibility is paramount. We did get our first question, and it was asked by somebody with an awesome first name, so we're going to entertain it now, as it's also relevant to this section of our discussion. So Nick asks, how important is the role of ESG today in driving occupier demand to new modern space? What does this suggest for obsolescence of older space going forward? Jennifer, Sam, I know this is a topic that's near and dear to you. Will, I'm sure to you as well, as MetLife obviously does a lot with respect to ESG. Does anyone want to tackle that first?
I can touch on it, and we were going to touch on this a little bit later in conversation as well. It's a great question. You know, when you think about where within the office segment investors might be targeting exposures and their preferences for really, you know, being mindful of ESG and DEI constraints that might be impressed upon them. So I think there are a few elements impacting this discussion that are related to ESG. First, you know, there is a locational element, sort of a geographic placement of office exposure in the world and what that means in terms of ESG. So locations with resilient and diverse demand drivers, and also, this is where the ESG comes into play, very supportive infrastructure, meaning proximity to public transportation, access to energy and utilities to kind of, you know, match the needs of the tenant base. There's also, you know, some ESG elements that are being incorporated in new and thoughtful design of the individual spaces, and mindfulness for elements that really help to promote high quality air and additional wellness within each building. So it's really coming back to that amenity package that helps health and wellness thrive in an office setting as well. And so, you know, there are also a lot of discussions about, you know, sustainable design and sustainable technologies and the use of those in design. And I think that just crosses right over to the office sector. And the office sector has historically been one of the best places to measure energy usage, because there is a little bit more control over the underlying tenant energy use than there would be in a sector like industrial or multifamily, for example. And so I think it continues to be a critical factor, but the truth is that you know, there are so many jurisdictions in the United States that require ESG to be incorporated in design and in development. And so by forgetting about that, I just think you're, you know, putting yourself in a disservice. You just can't simply do business in some locations where these elements might be present.
So maybe just to add on a little, within our portfolio, I agree, we've seen more demand for kind of higher end space that is usually newer and more ESG friendly. It's a little hard to disentangle how much of that is really being driven by a kind of sustainability motive. There are quite a few and a growing number of companies or office tenants who seek to be carbon neutral. And so when they're kind of pricing their leases out, they're looking at the cost of RECs and offsets. But RECs and offsets, as I'm sure many people are familiar, are so cheap today that that's, you know, just a rounding error compared to the cost of an overall lease. So I think bigger picture, to answer the next question directly, we haven't seen really direct evidence of ESG being a driver of leasing demand, although I suspect it is in the background, and I certainly think it's going to grow during the decade.
I think I covered the question really well. I would add, you know, I think the sudden, questions that we started hearing around air circulation and air quality within office spaces. They kind of came so suddenly and they've been rolled out so rapidly. It kind of feels like table stakes now. You can call that part of an ESG strategy for sure, but it also, I think, is just kind of going to become standard.
Yeah, and to add on to that point as well, some of those endeavors for higher quality air are also higher energy usage. So that has to kind of offset some of the other ambitions in these measurable categories within ESG. So it's a tricky conversation. And I think we're hearing the same thing, that there aren't a lot of, green leases necessarily being signed, but you don't want to do anything as a landlord to, turn away a tenant in this high vacancy environment either. So it's a little bit of a chicken and egg problem at times.
Thanks all. I appreciate you all tackling that question from the audience. Kind of a likely segue from space needs, Will, I'll direct this to you, has to do with potentially some office space requiring repositioning given remote working trends and changes in spatial demands. What is going to happen to less useful or outdated office space?
I think it comes down to residential. Office to residential conversions have been popular for many years, even before the pandemic. A place like downtown Manhattan lost or kind of reduced its overall office footprint by something like 5% in the decade leading up to the pandemic, while at the same time, residential, so this includes condos and apartments, grew by around 20%, again, in downtown Manhattan. And a pretty common value add strategy and growing value add strategy has been those office to residential conversions. As I'm sure everyone on the call is aware, home prices are up, apartment rents are up substantially during the pandemic. And in a way, this strong residential market sort of bailed out the office sector, or bailed out this work from home effect that has been a demand headwind, because a lot of those projects just look pretty attractive. There are certain types of office buildings, specifically those with large floor plates, where that doesn't work. A 70 or 80 story high rise in Manhattan can't be converted to residential because there's just not enough windows. But for a majority of office assets and suburban office assets, that's been a pretty viable strategy that seems to be growing.
Thanks, Will, and agreed on that. Jennifer, kind of getting out of the weeds and going a bit more macro, how are overall real estate allocations shifting in 2022? And what is the broader implication on the office sector?
Sure. I think IREI puts out a lot of good data on this from the investor sentiments survey that they publish. And I think that the way of the indices also tells us a lot about shifting preferences, because you have a lot of diversified managers, for example, sitting in the NCREIF Odyssey Index, and you can watch how those allocations and exposures have shifted over time. So, what we're hearing in our discussions with investors is not going to surprise anybody. It's really an underweight to retail and office relative to historic levels, and we'll talk about that in a minute. And then an overweight to multifamily, industrial, and some other niche segments of the market that have been attracting capital post-pandemic. So the sector weights within the indices that most U.S. institutional plans are benchmarking their real estate programs to. That's why I keep coming back to those references. They have also changed very significantly over the last 5 years in the United States, and these are private benchmarks. The two highest weightings, no surprise, are apartment. It represents about 27%, 28% of the total index exposure, and industrial, which is 28%. So those two sectors are up 2.5% and 15% with respect to industrial over a 5-year period. The other category, which contains some of that niche property type exposure, self-storage, medical office, for example, that segment of the index is also up. So it showed an increased level over the last 5 years. That increase in industrial take up in the index is also surprising for another factor in that, the size of those assets compared to office and especially Class A retail, it's relatively small. So think about that from a value perspective and also a square footage perspective. Office now represents the third largest property type in the index composition. It's just sitting at about 27%, but again, this weighting itself is down 11% over the 5-year period. So despite the higher asset values and larger size and floor prints of the office space, it's really a declining exposure within some of these diversified funds. And these are funds with multi-property type exposure, not just limited to those that are sector specific. Retail exposure is also down about 9% over the 5-year period in terms of its composition within the index. So I look at that and I think, yeah, that makes sense. And the bets that investors are making to outperform their benchmark are kind of following suit with those trends. Overweight industrial, highest performer; overweight apartment, resilient performer over multiple cycles; underweight office and retail. And so, nothing, earth-shattering in those statistics or that thought process, but it is one that's echoed. There's some discussion about the frothiness in certain markets or certain subsectors where property types have been run up in pricing. But we're still hearing a lot of demand for those exposures as well. So I'm really interested in other perspectives on that. MetLife with a diversified property portfolio, and Sam, I know you guys have quite a diverse portfolio at Oregon. So I'd love to hear your take on that, if it's on or off, based on what you're doing within your own program.
Well, we've certainly also reduced on a proportional basis office exposure, although the numbers you were citing, Jen, get a little confusing because life science is counted as a category of office in the NCREIF universe, which that's something I have a little bit of a pet peeve against. The only reason they count as the same category is because they look the same from the outside. The economic drivers are completely different. Conversions are very difficult. So I wish those two would be broken apart. So for traditional office space, we have reduced our proportional allocations a little bit, but are more active in the life science space.
Yeah, I think my next question was going to be about target allocations near versus long term. And I think, this ties in so well because to your point, Jen, this is, it's all a relative game when you think about building out your portfolio. And, given inflation concerns, the property types that we want to be in that are the most resilient, that have even if a partial inflation hedge, that's where we want to have an overweight right now. And I think to your point, Jen, like the benchmarking, as much as we are not benchmark huggers, as much as we don't want the institutional universe to drive our portfolio decisions, at the end of the day, they do guide them because there was such a sharp decline in the office allocation. We're benchmarked against NCREIF Odyssey from the start of the pandemic, start of 2020 to now. It's office has dropped 700 bips. So if you really weren't paying attention and trying to pivot your portfolio, you suddenly have a very active position against your benchmark with a strong overweight. And that, maybe doesn't align with where you thought you were trying to position your portfolio. We invested in a lot of separate accounts. And so it's a matter of making sure that, across some of our slower moving vehicles that we're able to kind of target those allocations that we want. And, at the end of the day, we kind of are constantly asked currently, what are the long-term fundamentals of suburban office versus CBD? And there is, I think, an importance in that shorter term tactical conversation, but at the end of the day, like, we're very long-term investors, right? We're trying to invest over at least a 10-year horizon. And so I think thinking too short-term about this can put you in a tricky place. But you also have to balance that with how quickly a benchmark can move. And Will, to your point, like, it's not just a matter of what type of traditional office you want anymore. It's the medical office exposure, your life science exposure. And so for us, that's been a really important part of our conversation in saying, we still think we're going to have a pretty meaningful traditional office allocation going forward, not nearly, over a third of our portfolio like we were historically, but let's replace some of that traditional office with some of the alternative uses, not completely, switch them. The majority will probably still be traditional for the near term. But that's definitely kind of a newer part of our portfolio build out that, long term we think is going to be important.
Yeah, it's interesting. I was just reading news article on European Odyssey, and their office composure hasn't really changed over the last couple of years. I think it was only down 2%. It's a pretty significant disparity between Europe and the US. One of the potential reasons that they cited was office leases being linked, at least in more so continental Europe versus UK, to CPI. So it really is more of a hedge against inflation versus the UK and other markets. We did get another question pertaining to small amounts of high quality suburban office. Will, I know you somewhat addressed this during the initial question, but Sam, Jennifer, wonder if you want to take a crack at your thoughts towards this type of, I guess, minor position in the portfolio as a strategy going forward, or yeah, if it's a little too into the weeds and you tend to think bigger picture than that.
I can comment just on, historical perspective on suburban office exposure, which, by the way, we had a negative experience with suburban office exposure through multiple market cycles. And the reason why was, while it produced really resilient income as a total part of the return, the challenge was in the appreciation and whether or not you could grow the value of the asset to a point that was competitive with urbanized assets, or those that are in, CBD and 24-hour and 24/7 cities. So first, I think that, kind of thinking back to that experience over multiple cycles, there was always a preference to shy away from suburban office. First, for the reasons I just mentioned, and second, the exit was always less certain in prior cycles than it is today, perhaps. And so, there are a couple things that, in speaking with investors, as we often do, that we're hearing, and there is more appetite for suburban office than there was previously. I think that's following demographic shifts. I don't think the market in general believes that urbanization is dead. So I think that maybe that's kind of a blip on the radar. People come back to the markets that used to perform really well post-pandemic, and we're already starting to see that growth happen. But there's also been sort of a flight east, a flight to the Sunbelt markets, for example. High population growth, yet office space availability is high. And it even increased during COVID. So I think that there's sort of like these trends that are contradicting one another. There's also a preference for employers and corporations to be located in tax-friendly space as well. And so that, that also facilitated the shift to other markets. And so I think that some of that does continue. I don't know if, specifically suburban and tertiary market exposure in office ever has the same resilient qualities as CBD office in terms of its exit potential. And for that reason, perhaps the appreciation component tends to be limited, but there's definitely more appetite for it today that we're hearing about.
I think in most markets, employers moving to the suburbs will not be a major trend, just because employees moved in lots of different directions during the pandemic. So in Manhattan, if a third of your workforce went to New Jersey and a third went to Brooklyn, Queens, and a third went to Connecticut, you sort of have to alienate 2/3 of your workforce to move into the suburbs. There's other markets like San Francisco where that was more of a direct line straight east, maybe northeast a little bit. But for a majority of cities, because the workforce has become kind of so scattered, at least this is what we've found working with some of our leasing brokers who have done surveys on this. It's just challenging as an occupier to figure out which direction to go in.
Mm-hmm. Yeah, I would agree. And I think, just the amount of supply that you encounter in those markets also, gives me pause, just because at the end of the day, it's back to this like relative call. I would rather, if I only have a limited portion of office in my portfolio, probably have a higher quality CBD, Class A property versus in the suburbs. And if I want exposure to that, area in the marketplace, I'd probably rather own a garden style apartment building that kind of, leases to a more affordable or essential worker. So from even just kind of a market perspective, that I think I would get that exposure elsewhere rather than from a suburban office.
Thanks all. I appreciate everyone answering that question for the person that asked it. Will, you touched earlier on the office to multifamily repositioning. Looking at other property types again, are there any learnings that can be applied from other property types that have gone through other struggles recently? For example, the retail sector?
Yeah, that's a good comparison point. So retail has struggled for 10 or even almost 20 years as a result of the kind of e-commerce headwind or consumers buying more goods online. And retail has also underperformed other property types. It's underperformed the NCREIF benchmark that Jen was mentioning before. And I think there probably is an analogy there with the office sector. The solution is something that's kind of simple, and I hope I'm not like insulting all the real estate professionals here, but the solution is to stop underwriting 3% rent growth in years 2 through 10 on every property type in every market, no matter what, which has been an industry standard practice for many years, and it's one of the reasons why retail is underperformed. It's that the assumptions have been too optimistic there. I think in the office sector, at least for our underwriting, we're looking at above 3% expense growth and below 3% rent growth during the next 10 years. And based on how office prices have been moving, that has still led us towards finding a small number of attractive opportunities. So it kind of comes down to the underwriting. And I feel like this 3% number has become a religious belief amongst real estate professionals. Anyone who's not in real estate probably thinks I'm completely crazy bringing up this really nuanced point, but I think it's really important, and it is a lesson to be learned from kind of the mistakes in the retail sector over the last 10 or 15 years.
It's not just beholden to office either, Will, right? I mean, think about the rent growth assumptions in industrial and those that occurred in, high-rise multifamily in CBDs, and those were unattainable. Well, the latter, multifamily, was unattainable. We have yet to see what industrial will do, but I think it's a lesson learned for all property types, not just office, but it's a really, really good point.
Jennifer, sticking with you, given Alliance's representation of investment managers across segments, where within the office segment might investors and investment managers target future exposure?
It's not dissimilar to the sectors that Sam was mentioning and Will was mentioning that are classified as subsectors within office. So medical office particularly, and life science. I think there was a lot of discussion, in the last administration on medical office and the impact of policy changes on that segment that actually never came to fruition. So I see a lot of opportunity to explore some of these niches, including medical and life sciences going forward, because those, some of the things that we thought might come to fruition and be challenges ended up not being challenges for those sectors. It's just really important that you're partnering with the right operator. I mean, some of these require, operational intensity that is beyond the operational intensity of a traditional office format, right? So I think that, some of the allocators that are just diving into the sector without the right history and performance track record may struggle to compete with those that have been through multiple cycles in those sectors. So first, Nick, I think it's the niche sectors within office. And then second, kind of focusing on assets that meet the future demands that are being forecasted. So not only in terms of location with this supportive infrastructure that we talked about earlier, but this thoughtfully designed product that's not going to suffer if it comes to fruition an ESG penalty upon exit, or it comes down to selecting the right locations that are supported by corporate growth and increased tenant growth, population growth overall, and then being mindful of the design. So I think there's still plenty of opportunity in the office segment. It just might look a little bit different than what it looked like in the past.
And Jennifer, we received a question that sort of relates to your response, and curious if you have a take here in terms of whether co-working will play a bigger role in office long-term than originally thought. I know, several years ago, everyone was asking how much WeWork do you have in your rent roll? How are you seeing that conversation play out these days?
I don't know if they were asking that because it was a threat to have WeWork exposure in the rent roll or an opportunity to have co-working exposure. I think that, I think the future of that segment looks okay. Okay, I think that there's a need for co-working, especially in an environment where tenants might, or employers and tenants might not be taking up the same amount of space to house full-time employees. But I think that the challenge in co-working is also, like, I'm sitting in my office in Columbus, Ohio. It is perfectly set up to work remotely. I designed it this way. I make sure my internet is connected to a landline. I have my phone as backup. Like, I am now used to this environment that I've been in for 2 years. And I think a lot of workers that didn't feel supported in this environment now feel supported. And so they have the opportunity to work from their location safely and securely in a way that didn't exist pre-pandemic. And so I think one of the challenges with co-working is that didn't really exist before. Maybe with some people, I certainly wasn't necessarily set up as to work as productively remotely that I am today. But I'd be curious on, the other points of view on the panel. I think there's a need for it. I find myself, flocking to co-working locations in Columbus because I mentioned we have an office in Naples. We don't have physical office space here in Columbus. So if I'm taking a meeting or I just want to get out of my house and get away from my 4-year-old, I might, choose to go into that environment. And I also, I love being in the office. That's my preference, is to be in an office. So I think personal preferences might impact it. So there will be a need for co-working spaces. I feel also really comfortable where I'm at.
I think one lesson that we learned from the pandemic, which almost feels obvious now in retrospect, but it wasn't intuitive in 2019, at least not to me, is that the value of an office is not a stable, distraction-free zone with a solid internet connection. The value of an office is collaboration and building a company culture and building trust. That has translated into a change in the types of tenants that co-working operators are seeing. What used to be individuals that would rent space for short periods of time has that block of business has declined for co-working operators, but where they've seen significant growth is in group. So 10, 20, 30, or even more people than that wanting to rent out a large block of office space for 1 week is where there's been quite a bit of growth. To answer the question directly, which was, do you think co-working will play a bigger role than originally thought? Our point estimate before the pandemic was that co-working would make up 10 to 15% of all office space by 2030. And today we're just forecasting 10%. So I guess, net between that kind of shrinking block and increasing block of demand, we sort of have downgraded a little bit how strong we think co-working will be.
Mm-hmm. I'll echo that. We're 10% or under for our guests. And I think it's all part of the flexibility equation. There's no one right way to work now. And if you want to go in so that you're not at home with kids, that's a really good solution for some people who might be in the suburb where there's really no other kind of designated space provided by their company otherwise. But at the same time, to Will's point about, what we've learned about our office environments, I learned that the office environment can be really distracting, right? I like talking with my colleagues. I like catching up. I like talking about things that are not real estate related 100% of the time. And so for some of my days, like if I just have a lot of work to grind through, for me, I'm more productive at home. But for some of my colleagues, they might be more productive in an office space. And just kind of catering to how people have learned that they work best, that might include a co-working space, and it might not. But I think in terms of kind of long-term fit in the office sector in total, I think there's a role for it, maybe just not as kind of exponentially growing as we maybe once thought.
Yeah, I agree with a lot of that. And Jennifer, to your point, I don't know about you, but I can't take any more meetings in restaurants. Just don't get much done in restaurants. You need some actual community space to collaborate, whiteboard, do whatever you need to do. So completely agree with you there. Will, where do you think the best risk-adjusted return is in the office sector? So thinking of areas like commercial mortgages, core equity investments, value add, opportunistic, et cetera. Excited to hear your take going forward.
So at the start of the year, I would have said commercial mortgages have strong risk-adjusted returns, and value add, specifically buying high vacancy assets and improving them, or doing the kind of conversion into residential. Pricing has changed quite a bit since the start of the year, and even over the last couple of months, to the point that I think one area, and this may sound a little bit out there, but opportunistic deals, so building ground up brand new office buildings, is something that there is almost zero appetite for, but there are a small number of high growth markets where the economics are pretty attractive, even assuming zero or negative rent growth, pretty worst case scenario expense growth, very long lease up periods. Just the economics of that is kind of a counterplay or contrarian play, looks pretty attractive. So even though there's not, it wouldn't be possible to place $10 billion into ground up development for office, for the small number that exists, those look pretty attractive. And then just core assets, that the yields and cap rates in that sector have been moving up, I believe, and that now looks more attractive. In the commercial mortgage space, it's not looking on a relative basis as attractive as, again, core and opportunistic. So it's really been a full 360 flip from the two that I thought were better at the start of the year to where I think the best opportunities might be today.
Anyone else want to attempt to answer that? No worries. We're about at that time anyways, where I'm going to ask each of the panelists to give their major takeaway or two takeaways from today's discussion. So Jennifer, let's start with you.
Yeah, I really appreciated and love Will's stats and Sam's stats about the co-working space. We didn't plan for that question, so I like introducing that in the conversation, so thank you. I think I go back to a story from about a month ago. Heather, my partner, and I were in New York City, and we have, neither one of us had been there since pre-pandemic, and we're like, we're not quite sure how these meetings will go. We ended up having 16 meetings in about 48 hours, which is pretty efficient and difficult to do depending on geography, but we did it. And I was really encouraged by the number of people in the offices. You could tell that they were not as occupied and as full as they were pre-pandemic. Not every single employee was in the office at their desk at that moment in time, but there was activity. There were people, certainly the people that we were there to meet, we had in-office meetings with. And so I think that that's really encouraging. And I also think that there's some encouragement in the sentiment that, somebody I used to work with mentioned to me about what they're hearing in the market, which was, everybody wants an office that nobody has to go to. And I think that's sort of like a brilliant philosophy to think about when we think about the future of office, which is even if people are not occupying the space, there is still a need for the space, especially where there's a war on talent and a very competitive hiring environment. And that's a challenging thing right now, especially in our sector. It's really tough to get talent. Talent's very expensive. They have a lot of demands. And if you're not poised to meet those demands, many of which include elements about the physical location and office environment, then you'll struggle with talent. And I think that could potentially be a downfall to certain businesses. So I think that those two anecdotes are what I would leave the audience with today. I think that there's been a change to the office environment but it still, exists going forward and deserves a place in an institutional portfolio, at least with some exposure.
Thanks, Jennifer. Sam, you want to
Sure.
provide your takeaways?
Yeah, so I've really appreciated this conversation as well, and really enjoyed Will and Jen's comments. And, one of the areas that we've spent some of our portfolio in recently have been traditional office conversions into medical office in the right submarkets. And, it kind of gets me excited when Will says, the conversion of office to apartment buildings. I like thinking about how we can be more creative as real estate owners in the way that we access value. As an industry, we're not the most cutting edge. We don't adopt technology tremendously rapidly. We're a little bit slow moving, but when there are those types of conversion opportunities or just these disruptions that give us the space and the time to say, how are we, how could we think about things differently? I think it's an exciting time to be in the real estate industry as we kind of tackle some of these headwinds, but also tailwinds. And I just appreciated this conversation.
All right, Will, your turn.
So I think if we were to all get together 5 years from now and look back at how did the different property types perform, and we could use the NCREIF property index, I suspect that the average office return will underperform the average asset in the NCREIF universe. So underperform the apartment, industrial, retail sectors. But because there's so much stigma here and there are going to be winners and losers, I bet if we look at the top quartile of office assets, that will outperform the top quartile of NCREIF assets. So I think the office sector is one to not be complacent on, not be a market taker on today. It's a sector where it's important to come with required rates of return and have conviction around expense and rent growth assumptions, vacancy assumptions, and then really have an independent view of value. And in some areas, when we've applied that, we've thought office buildings might be 20 or 25% overvalued in terms of where we would buy. And in other areas, we found undervalue. And that's not true of the other sectors today. So I think I'd just throw that out there, that the index overall, or just buying the office index, doesn't seem like a prudent investment to me today, but kind of carefully placing and deciding on the office strategy could yield pretty good risk-adjusted returns.
So said differently, more of a bottoms-up approach, asset selection approach is going to be more important for the office sector versus other sectors potentially.
That's exactly right, Nick. Yeah.
Yeah, I agree with that as well. Well, fortunately for me, we only have a couple minutes left, so I don't have to provide my takeaway. John, I will hand it over to you after I thank all the panelists today. This was a really fascinating discussion, and I appreciate how prepared all of you were for today's chat.
Excellent, Nick and panel. Thank you, Nick, Jennifer, Sam, Will. This was a terrific conversation. A lot of information shared here. It continues to intrigue me how the topics around office change regularly. We're on a European call this morning around office specifically and how it changes. And a lot of the attention was focused on culture and bringing up candidates. So it goes, there's so many pieces and aspects to this office conversation that I'd like to invite you and all of our people that attended today to continue this conversation. We have a widget on our website to go in and encourage topics, to keep these things going and keep the feedback loop going, to keep this information as it changes regularly in front of us, to really keep that energy going. And really appreciate the panel's expertise today. There were some great takeaways in here. Also want to thank you quickly, MetLife Investment Management, Juniper Square, for making this possible today. Without you, this wouldn't have happened. And really thank you to everyone that registered for the event today. I sincerely hope you found this time to be valuable, and also like to invite you all to join us on, we have 2 remaining IREI live webinars coming up for the rest of the year. One will be August 30th for a global look at multifamily, and the other one on November 29th for the topic that many might be familiar with ESG, that's ever changing as well too. So once again, thank you everyone for showing up today. As always, if you have feedback on how we can continue to elevate our level of service to this community, please reach out to me directly. We're here to serve you and want to make sure we're doing the very best we can. Until then, have a great day today and have a safe 4th of July weekend this weekend. Thanks, everyone.